I have made over $1 million in profit throughout my entire day trading career, and every single trade that I take is based off of liquidity sweeps. Today, I'm going to break down how you guys can spot liquidity sweeps within the market so that you guys can start taking profitable trades based off of liquidity. But before I can send you guys off on your own, first we have to talk about where liquidity even lies within the market. Before learning about liquidity sweeps, almost every single trade that I would take, I would enter in, and then I kid you not, I would get stopped out and then see price shoot into the direction that I wanted price to go. I lost funded accounts, thousands of dollars, and I lost confidence within the market, all because I didn't know about liquidity. I'm here today to hopefully save you guys the time and the money that I lost trying to understand these concepts, and hopefully get you guys over the struggle that I had to go through in order to understand these things. So if you guys are ready to take your trading to the next level, I highly suggest that you guys stay for the rest of this video. If we want to be able to take trades off of liquidity sweeps within the market, we have to know and understand where liquidity even lies in the first place. And liquidity, believe it or not, is actually one of the easiest concepts and one of the easiest things to identify within the chart. So first thing that we're going to do is we are going to go up here and I'm going to draw you guys some examples of where liquidity lies. So everybody knows about highs within the market, okay? What consists of a high? A move up and then a move down, right? If it was just moves up and up, there's no peak, okay? So we need a move up and then a move down. This is plain and simple a 2 candlestick pattern. Yes, that's right, TJR, trading candlestick patterns. Pretty freaking crazy. But it's a 2 candlestick pattern, a up candle and then a down candle, okay? And then what makes up a low within the market? A move down, then a move up. Same thing here. If it's just continuous moves down, we never get the actual low, because for it to be a low, it needs to have a little move up after that. Okay, now with this in mind, what do we know about trend traders and most retail traders? And again, for the most part, we are not trying to trade like retail traders. We're trying to trade with the algorithm and with the banks. So with that in mind, we know uptrends moving higher highs and higher lows, right? But at some point in time, these trends have to change. And the best trades to take are more often than not going to be the trades that you can take right up here on those reversals. And that's what liquidity sweeps help us do. And then same thing with downtrends, right? More often than not, we're not trying to catch this little measly move down. We're trying to catch this low right here for the start of a new uptrend so that we can make a lot more money than just trying to trade this little trend on down, okay? So with that in mind, okay, and trust me, this is all going to come together. With that in mind, why did we talk about highs and lows within the market? Well, when we are moving in an uptrend, what typically happens when we push past a high? Well, retail traders, they say, oh, we're in an uptrend. So what are they going to do once they push past a high? Higher highs and higher lows. They are going to press the buy button. So there's a lot of people that are placing buys right here, okay, above these highs. And then also what is happening? Maybe some people wanted to sell on this move down, right? People thought that this was actually going to go lower. And with that in mind, where do most people place their stop losses when they're selling? Above highs. So with that in mind, if this high gets pushed past, all the people that were selling on this move down, what are they going to have to do? Because of their stop losses, they're going to have to buy back their position at a higher price because they got stopped out. So we have people that are buying right here because they think the trend is going to continue. And then we also have people that are buying their positions back at a higher price because they simply just lost on this trade. So there's a lot of retail traders placing buy positions above highs. Now you're seeing where the highs come in. Now, same thing within downtrends, okay? We know retail traders, what happens when this low gets pushed past? A lot of people are going to be selling. Why? Because they say, hey, we're in a downtrend. It's going to keep going lower and lower and lower and lower and lower. So they're going to place sell positions here. Same thing on the contrast, right? There's this little move up. Maybe some people thought, hey, it's going to reverse right here. I'm going to place a buy. Where is their stop loss? Their stop loss is going to be underneath these lows, okay? So with that in mind, if they're placing a buy, what will they have to do if their position gets pushed underneath their stop loss? They're going to have to sell their position back for a lower price, in turn losing that trade. So we have a lot of people that are entering into sell positions underneath lows, and a lot of people who are entering into buy positions above highs, okay? Oops, let me get rid of this one first. Boom, sell positions underneath lows and buy positions above highs. Okay, so now you're probably thinking, well, what does that Apple stock comparison have to do with anything? Well, that still applies to the market that we have today. So with that in mind, okay, we know that there's a lot of buy orders that are sitting above highs within the market and a lot of sell orders that are sitting underneath lows within the market, okay? So with that in mind, what happens when we push underneath a low and the market makers and the algorithm want to reverse price? Well, since there's already a ton of people who are going to be selling right here, what are they able to do? Fill a ton of their buy positions to end up reversing the market. And that is where liquidity lies. Okay, same thing here. Where does the liquidity lie within the market above these highs? Why? Because there's going to be a lot of people that are going to be placing buy positions once we push past these highs. And what does that give the markets the ability to do? It gives them the ability to fill a substantial amount of their orders up here and cause price to reverse. Okay, and you're probably saying, well, why not within an uptrend? Why can't they just do something like this? Well, that's the thing. Market makers are very greedy. Why would they want to fill their order here when they could fill their order above these highs? And on top of that, if they were to fill their orders here, they would not have the liquidity, they would not have the liquidity to fill their orders. So in turn, they would fill sell orders here and then price would move down. Fill sell orders here, price would move down, sell, 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 sell. They would be getting the worst price, and they're greedy motherfuckers, okay? They would be getting the worst price on their entry. And the market makers, you know them, they're never, ever, ever going to not get what they want, okay? So what do they want? They want the most optimal price to enter. So what do they know? They know, hey, a bunch of people are placing buy orders above these highs. If we fill all of our sell orders in contrast to their buy orders, what will happen? Well, plain and simple, price will be able to stay up here for a short amount of time for them to fill all their sell orders. And on top of that, when they do fill all of their sell orders, they are getting the highest top tickety tip price for their sell orders, and they are going to make a shit ton of money because price is going to move down. Why? Because they were able to fill their sell orders. Same thing within a downtrend, okay? Why on earth would the market makers want to fill their buy orders right here when, if they filled buy orders right here, it would go up, buy order, up, buy order, up, 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 and their buy orders would keep getting filled higher and higher and higher because plain and simple, the market does not have the liquidity to fill all of those buy orders at once. But where does the market have the ability to fill all those where does the market have the ability to fill all of those buy orders at once? Underneath these lows. Why? Because there's a ton of sell orders. So going back to that Apple example, that's what I was trying to explain to you guys, where we are still operating within an exchange. So we need a significant amount of sell orders for the market makers and for the algorithm to fill a substantial amount of buy orders underneath lows. And then when they fill right here, what do? They get that perfect price. They get the best entry. And what do we want when placing trades within the market? We want the best trades. We want the best entries, and that's why we enter off of liquidity sweeps. Now, obviously, we can't just press buy every single time a low gets pushed underneath, and obviously, we can't just press sell every single time a high gets pushed above within the market. Understanding where liquidity lies is literally just the first step of being able to take trades off of liquidity sweep, and also just one part of understanding the charts fully. But it's also very important that we understand what liquidity is and why it causes the moves it makes from those lows within the market and from those highs within the market. So I'm going to tell you guys a little story about back when I traded Forex and when I was trading London session. Pretty much every single trade that I would take, I would get stopped out of my trades right when London session would start, and then I would see price rip in the direction that I wanted it to go for the day. And I even made my own strategy based off of this. I called it the London session fake out. And I had no clue what liquidity was at the time. And little did I know, this was actual liquidity being swept every single time London session would open to fill orders for the move that it wanted to make. So now that we know where liquidity lies, but understanding what it is and why it moves the market at certain times and prices is even more important. So now that we know where liquidity lies, we also need to talk about what even is liquidity in the first place. And we kind of mentioned this before, but we're going to get into a little spelling lesson here, okay? So we are going to go ahead and define what liquidity is, because if we don't know what it is, then why are we even freaking using it? I make sure that every single one of my students knows the actual confluence that they are using and why they're even taking a trade in the first place. If you don't know why you're taking the trade, you probably shouldn't be taking the trade. So we need to understand our confluences fully. So that's why we're going to be explaining this right now. So what? Okay, I dropped out of college for a reason. What is liquidity? Let's at least spell liquidity right. Liquidity. Okay, liquidity is resting orders. Okay, and just like I mentioned beforehand, we know that we have resting buy orders above highs and we have resting sell orders underneath lows. Okay, so now we need to go into why do we use it? Okay, so why do we use liquidity in the first place? Because we know that that is where reversals are going to happen, or have the that is where we have the potential to have a reversal. And that's the biggest thing. That's why we aren't just pressing buy right when a low gets pushed underneath. And that's why we aren't pressing sell right when a high gets pushed above, right? Just understanding where liquidity lies, that's just one step of the whole process. Or else we would be the worst traders in the world if we were doing that. Okay, but why do we use it? It's because it has the potential to reverse there. So we want to mark out pretty much every single draw on liquidity that we have within the market, so that we can see, hey, price can potentially reverse off of this. And with that in mind, we are going to be able to catch the very tippy top of those new downtrends that get formed. And with that in mind, we're going to be able to catch the very itsy bitsy round double cheeked up bottom of those new uptrends that are going to form. So why do we use it? Price has the we might as well put that in there, potential to reverse at highs and lows within the market. Okay, now that's just talking about liquidity. Liquidity itself is resting orders. Now let's talk about liquidity sweeps. So what does it mean when liquidity is actually swept? That means those resting orders have been filled and we actually started that reversal process. So let's talk about liquidity sweeps. I'll just do this. Are when those resting orders actually get filled and start a new trend, either up or down. Bang. Okay, so what is liquidity? Liquidity is resting orders. I'll add on to this. Above highs and below lows. Why do we use it? Because price has the potential to reverse at those highs and those lows because of those resting orders that are above those highs and those lows. And then what are liquidity sweeps? Liquidity sweeps are when those resting orders actually get filled and start a new trend moving either up or down. So now with that in mind, let's show a couple examples of this within the chart, and then I'm going to show you guys how you guys can actually create your own strategy to actually be able to take profitable freaking trades using this new concept. All right, let's actually get into the freaking charts and let's show examples of where liquidity lies. We'll do two examples. Where liquidity is on the chart, and trust me, there's a million places where liquidity lies. And then we'll also show liquidity sweeps. And then from there, I'm going to show you guys how to actually execute trades so that you can know and understand when liquidity is actually being swept or if the liquidity is not going to be used or not. Because I know a lot of people, myself included, sometimes will push above a high. And obviously we don't want to just press sell, but we need some sort of confirmation to understand, like, hey, liquidity has actually been swept and we are going to start that reversal right now, okay? Because again, pressing sell at highs and pressing buy at lows, that's like the worst strategy ever, okay? So we'll start off and we'll just, again, price is fractal, okay? So there's liquidity on every single time frame. That's the awesome thing about all of my confluences. You can apply this to any time frame that you want ever, okay? There's liquidity on the weekly time frame, there's liquidity on the monthly time frame. I can literally show you an example of liquidity sweep right now on the monthly time frame. Okay? Right here. Look at this. Okay? What do we have? Right here. Oh, that's a low. Oh, wait, I don't have my magnet on. That's a low. What's this? Oh, that's a low. What happened? The monthly time frame moved down, swept liquidity, and then what happened? Bull run, bitches. Okay, so that's just one example. But let's first talk about identifying where liquidity is. Remember what we said? Liquidity lies above highs and below lows. So when we're marking out draws on liquidity, what do? We literally just mark out highs and lows. And you're probably saying, well, there's highs and lows literally everywhere. You're right. But we are going to get into how we can actually identify which draws on liquidity we want to use, which draws on liquidity are going to be higher value for us when we start getting into the timing of all of this. Okay, so just bear with me. But for now, let's practice and let's show where liquidity lies. And remember, lows, what are they consisted of? Move down, then a move up. Okay, 2 candlestick pattern. Okay, highs, what are they consisted of? Move up, then a move down. Okay, so what do we see here? We see a move up, then a move down. Boom, that's a draw on liquidity. We see a move down, then a move up. Oh, that low, that's a draw on liquidity. Okay, we see a move up, then a move down. Oh, that high right there, that's a draw on liquidity. Move down, then a move up. Oh, that's a low. Boom, we've already marked out a ton of draws on liquidity. But as we can see right now, like we moved past this high. TJR, why didn't we reverse? Have you even been listening? Wow, I literally switched the chart with that slam. You haven't been listening, numbnuts. We're going to get into how you can actually take a trade on it a little bit down the line, Timmy. Okay? But again, we can do this on literally any single time frame. We want to understand where liquidity lies. Well, it lies above highs and below lows. Okay, so high, we have a move up, then a move down right here. We can see that there, a little sweepy. Okay, we have a move down, then a move up. Boom. That's a low, that's a draw on liquidity. We have a move down, then a move up. Boom, that's a low, that's a draw on liquidity. We have a move down, then a move up. Boom, that's a low, that's a draw on liquidity. Okay, so we know where liquidity lies. It's above highs and below lows. We know how to mark out highs and lows within the market. But what we want to do now is be able to identify liquidity sweeps. So before I actually go in and show you guys like how we can see where liquidity sweeps are, let's show a couple of examples of liquidity sweeps that have already happened where we can see like, hey, this liquidity thing, it's pretty freaking for real, okay? So I showed you guys that monthly time frame example. Let's show you guys another example, okay? So I just spotted one. This is a perfect example right here. Within this move up, right? We're in an uptrend. We break structure off these highs, right? What do we have? A high. What do we see price do? Sweep work, fill all these orders, and then what happens? Brrr, price just rumbles on down. Rumble freaking mania. Okay? Let's show another example. Boom, right here. What do we have? Highs within the market. We come up. Liquidity sweeper. Someone bring out the broom. Boom. What happens? Rumble mania. Okay, and again, this happens on every single time frame. Look at this. Tell me this shit doesn't work. What? A high? Oh, sweeper. And then what? Literal monster cock to the downside. Okay? Couple examples. Okay, and you're probably saying, well, this is just the 4-hour time frame. We can find this on the 15-minute time frame, literally on every single time frame. Look at this. Literally, like, I have aimbot with this shit. Highs right here. And obviously, since this is on a lower time frames hold higher power and obviously have smaller moves, but we can see move up, then a move down, these highs, sweep work, move down. Let's find another example. Oh, that's an example on the hourly. We can go ahead and show that. Look at this. We got a whole bunch of these lows. Low right here. Low right here. Low right here. What happens? Sweep work, move up. This happens on every single time frame. Same thing right here. Look. Boom, come down, low, low, sweep work, move up. Plain and simple. Plain and freaking simple. What's this right here? Sweep work, move down. Okay, but obviously, you're probably thinking, how the freak are we able to take trades off of this? Because it's super easy in hindsight to be like, well, duh, this was a liquidity sweep. We moved above a high and then made moves down. Okay, right? That's super easy to do. Going back into another little story time, okay? Back when I traded that London session fake out strategy, I would literally do what I was just showing you guys on the chart, and I would be like, oh my God, I know that when it moves above a high or when it makes a big move up right when market opens, it's gonna go down, but I just don't know where to put it, okay? And I would literally just blindly press buy or sell right when those moves down or up would happen, which again, probably not the best strategy, but I was going somewhere with that, okay? This obviously didn't end that well, but it was a step in the right direction for the unprofitable trader that I was at the time, okay? Now, you guys know much more than I did at the time now. The final piece of the puzzle is just how to properly take trades off of liquidity sweeps. So, with that being said, let's get right into it, and we are going to talk about session times, when and where price typically sweeps liquidity. Let's get into this shit. The very first thing that I want you guys to do is identify what session that you guys are trading. Right now, at this point in time, I am only trading the S&P 500 and NASDAQ. So what session do I trade? I trade New York session. If you guys trade London session, then awesome, we are going to apply this to London session. If you guys trade Asian session, you're an idiot, but sure, we'll apply this to Asian session too. Asian session just has really low volatility, so I don't know why you idiots are going to be trading that, but whatever floats your boat. I trade New York session, so we are going to show examples from New York session on how to actually take trades. So first and foremost, what are you guys going to do? And again, this applies to every single session. You guys are going to mark out session open, okay? So for New York session, session open is at 9:30. We're going to put that one there. We had non-farm payroll on Friday, so kind of like pretty ugly price action, but we can still show examples from it. Okay, so you guys are going to go ahead and put on market open. Now, once you guys do that, for me and my strategy, what I like to do is I like to mark out high time frame or relatively high time frame draws on liquidity. And remember, what are those? So literally just highs and lows within the market. So for me, I typically just go into the 4-hour time frame and the hourly time frame, and I mark out the highs and lows. So where are our highs that we made during pre-market? Okay, so we have some 4-hour highs right here, and we have some 4-hour lows right here. And those are really just the only ones that I can mark down. Okay, then let's go into the hourly time frame, and let's mark out some hourly highs and lows that we have. Okay, we have these hourly highs right here. We have these hourly highs right here. And we have these hourly lows right here. Cool. So we have 1, 2, 3 forms of, this is what's called buy side liquidity. Why? Because it's towards the buy side, like where the buy orders are getting filled. Ooh, pretty cool term. That whip that one out on your friends instead of your dick next time. That one will be nasty. Okay, boom. We got buy side liquidity, and then we have sell side liquidity down here. Okay. So from there, once we do that, that's typically all that I really need from the high time frames. From there, we'll just scale down into the low time frames. Okay, so all of you guys are going to be using different confluences for this. I have a full boot camp and a full free course where I teach you guys like how and what confluences I use. Right now, we're just talking about liquidity. So there's going to be a couple concepts that I may talk about within here that you guys don't fully understand. If you guys do want to understand it, you guys can go ahead and watch the free course, or you guys can join my mastermind where I literally teach all of you guys this stuff. Super in-depth for a month long. It's live recordings with me where you guys can ask questions for literally an entire month. And on top of that, you guys get added to the Discord. That's super freaking clouded. And you guys get a free $100,000 funded funded account for you guys so you guys can kickstart your profitability journey. If you guys want to do that, there's going to be a link in the description for both the free course and for the mastermind. You guys can look into that if you guys don't understand these confluences that I'm talking about. But without further ado, let's get into this. So, right when market opens, we see, oh, liquidity, it got touched. Do we press sell? No, idiots, you're gonna get stopped out if you do that. And as you can see, price moves up. Do we see any sort of reaction off of this? No, so liquidity has not been swept. Bye-bye. The next one, this hourly high. Oh, do we press up? No. Whoa, what just, wow. The chart was not liking how I was talking to him. Okay, we push past liquidity, what do? Do we press sell? No, we have to wait for confirmation because again, when price pushes towards liquidity, what does it have the potential to do? It has the potential, just the possibility to fill orders. It doesn't mean it has to happen. Because if it had to happen, then the market would just forever move like this. Oh, above a high. Boop, 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 boop. And that's just not how it works. We all know that. Okay, so we move past this one. Did anything happen? No. Oh, what happened to my face? There we go, fix my face. Boom. Nothing happened, okay, above these highs. Whoa, why do you not like me? Okay, continuing. We push above these highs and these highs. Do we get a reaction? Boom. Yes, we do get a reaction, okay? From there, once I see this big, thick ass black, whoa, wow, pause, not thick ass black. Okay, once I see this down candle off of these highs, what am I thinking? I'm thinking, okay, liquidity has potentially been swept. So from there, I scale down into the 1 minute time frame. And again, some of you guys might not understand these concepts, but that's where the boot camp and the free course and the mastermind is going to help you guys out. What do I see? I see a break of structure. Boom. Then what do I see? I see price retrace into an imbalance, fair value gap, if you guys want to get fancy with it. And then what do I see? I see sell orders coming out of that. In fact, I took this exact same trade. I took this trade, boom, right here, and I had my stop loss above these highs. Okay? Look at that. Awesome freaking trade. And the awesome thing about liquidity too is that you can not only use it for entries, but you can use it for exits. Why? Because the market moves off of liquidity. So if we know that in order for the market to move, it needs liquidity, we can understand that, hey, when price reverses off of this, where is price going to go right after that? To another draw on liquidity. So if we go down and back into the 1 hour time frame, this was a very not so sexy looking price action day, but we can see move down, then a move up, and this move up was made right when market opened, but boom. What is that? It's a low. What rests underneath lows? Liquidity. Then what do you know? Price goes down, hits take profit. Bang, bitches. Bang. Okay, let's show another example of this. Let's go into the S&P 500. Show an example in the S&P ski. Again, what do? We want to mark out where session opens. And again, you guys can literally just type in, when does London session open? When does Asian session open? When does New York session open? And it'll give you a solid answer. Okay, let's go ahead and do Wednesday's price action. I have no freaking clue if Wednesday was good price action or not. But I mean, clearly it was. Look at that, liquidity sweeper. Okay, boom, this is market open. What do? For me, I go into the high time frames and I try and see, hey, where are the lows, where are the highs? We see that we have a 4 hour high right here. Boom. We have a 4 hour low all the way over here. Okay. On the hourly, we have move down, then a move up. And again, Not the best price action, but we'll take it. Move down, then a move up. What's this? Another move down, then a move up. What's this? Another move down, then a move up. Oh, it looks like this was already taken out. Boom, we'll put that there. Okay, cool. Also, highs on the hourly. Okay, we have a move down, then a move up right here. That was actually already taken out during pre-market, so I'm going to go ahead and get rid of it. We have a move up, then a move down. There's a high. Move up, then a move down. And then another move up, then a move down right here on the hourly. So with that in mind, we've marked out a bunch of draws on liquidity on our high time frame. Let's get down and dirty into this. Okay. Market opens. We immediately push underneath this. Do we see any reaction? Do we see any reaction off of this? No. So are we just going to blindly press buy? No, Timmy. We already went over this. We push past these lows. Do we get a reaction? No. So we're not just going to blindly press buy. We push past these lows. Do we get a reaction? Oh, yes. A glorious, blue, luscious, huge candlestick. We got a reaction. Okay, from there, I see the reaction. I scale down, lower time frame, beep, bop, boop. And then all that we're looking for is extra confluences. And you guys can use whatever the fuck confluences that you guys want. You guys can use freaking, I don't know, like you guys can use indicators if you guys want, or you guys can use my confluences. I like using break of structure, inverse fair value gap, fair value gaps, order blocks, and breaker blocks. I know that maybe sounds like a foreign language to some of you guys, but this shit really fucking works. So again, if you guys want to learn about that, I got you. Okay. But what do we see? That glorious move up. Okay, and then we chop around for a little bit, but then what happens? We get a 1 minute break of structure right here. Then what happens? Oh, what's that? Little imbalance gets filled. We see buy orders come out of it. What do I do to buy orders coming out of a fair value gap after a break of structure, after we confirm that liquidity has been swept? We go long John fucking Silvers on their ass. Boom. And then again, where do we take the trade up to? Draws on liquidity. These highs, bang, bang. Sniper. Okay. We're smacking that shit. Okay. So last but not least, I'll do a quick little example on Forex. Okay, how we can do this. And we might as well do it on freaking London session. Why not? I can't even remember when London session starts, if I'm being dead honest. It's been so long since I've traded Forex. I'm pretty sure it starts at like 3. Oh my days. Look, bro. I shouldn't even have to say it. Do you guys see this? What is this? It's a high. What happens? London session opens, sweep, fucking avalanche. Bro. Tell me this shit doesn't work and I'm going to open up your asshole. Okay. I'm kidding. I'm not going to do that, but I might if you tell me this doesn't work. What do we have when market opens? We have highs. Market opens. Oh, sweet work. Scale down, lower time frame. Does somebody smell that? I smell a reaction. Boom, move down. We can literally just wait for like a 5 minute break of structure. We can wait for anything. Okay, we see a move down. What do? Jump down, 1 minute time frame, and again, you guys can have whatever freaking confluences you guys want for this. Oh my. I literally might start trading Forex again because of how hot this entry is. Tell me this shit doesn't turn you on. Move down, then a move up. What do we get? Break of structure right here. Come on, bro. TradingView doesn't want me to nut over the screen, bro. Pissing me off. Boom. We get that break of structure. Okay. Then, what's that, Timmy? Breaker block. That's right. I'm gonna break your cock. Okay, I'm kidding, Timmy. We get a move up into the breaker block, reactions to the downside. I'm literally I'm literally putting my entire account on this trade. Oh, and then we didn't even mark out any of the draws and liquidity to the downside. Lows right here. We'll literally just use that because this is just like a dick throbber of a trade. Tell me this shit doesn't work! Tell me this shit doesn't work! Literally the first freaking screen that we pull up on Forex is like the hottest freaking trade that we've seen in our entire lives. Liquidity sweeps, ladies and gentlemen, read it and freaking weep. Now you guys know exactly how to identify liquidity sweeps in the market, how to take trades off of them. This is a video that unprofitable me literally would have snuck a handy under the desk while watching back in the day because I really could have used this back when I was trading that London session fake out strategy, and I hope it finds a few people who need it, okay? Save this, come back to this as many times as you guys need it until it's freaking ingrained in your head. As always, I love and appreciate you guys. Peace the fuck out.